All right. Today is Wednesday, March 17th, and this is a recap for the stock market activities today. We had the big event, the most anticipated event of the FOMC meeting and the press conference with Jerome Powell. And as expected, we did not receive anything new from the Federal Reserve or the conference with Jerome Powell. It was more of the same, and in summary, we don't see inflation yet. And we want inflation to rise higher, and we're not even thinking about tapering the bond purchasing program, aka the cocaine operation. And even if things get out of hand for whatever reason, then we have the tools to deal with that, and we will let you know ahead of time before we start tapering the bond purchasing program. Sounds like a sweet deal, isn't it? Too good to be true. There is no inflation. The economic recovery is going as expected, if not even better. And the Federal Reserve is committed not to raise interest rates and not to taper the bond purchasing program. What is the problem here? We should put our blindfolds on, go back into the casino, and buy. Am I right or wrong? Because here is the problem. The recent sell-off we saw in the stock market was due to action in the bonds market, specifically the sudden extreme rise in Treasury yields. So did the talk from the Federal Reserve today and Jerome Powell do anything to address the problem of rising yields? Absolutely not. They will not do anything right now to manipulate the yield curve, meaning that the threat that caused the sell-off the last couple of weeks for the Nasdaq is still here and was not addressed by the Federal Reserve today. So why did the market rally today, closing well above the lows of the day right after the decision from the Federal Reserve and the conference by Jerome Powell? Because the problem was not addressed. We got more of the same. We will not raise interest rates. We already know that. We will not taper the bond purchasing program. We already know that. And yields continued to rally, even though we knew the Federal Reserve is not going to taper the bond purchasing program and will not raise interest rates. So once again, why did the market rally when the problem was not solved or addressed at all? Perhaps yields retreated significantly after Jerome Powell's speech. Perhaps bond market investors liked what they heard from the Federal Reserve. No, not at all. Yields on the 10-year Treasury yield closed above 1.6% today. So the real question is, did we just see a fake rally, a knee-jerk reaction to the decision and the press conference by Jerome Powell? Was the response just algorithmic? We will start to comb through what we did today in the next few days, perhaps, because we saw the Dow Jones rallying, the S&P 500, the Nasdaq, the Russell, the inflationary trade, the deflationary trade, the reopening names, the high momentum, high growth names, everything rallied together and pretty much telling us that the algos liked what the Federal Reserve said today. The problem is, if you did not address the problem of rising yields and you just gave more assurances that the market looked over the last few weeks, let me address the question to you. If you are selling your high growth names because you were worried about the rise in Treasury yields, and you know that the rise in Treasury yields is due to the rise of inflation expectations, did anything that came out of Jerome Powell's mouth today convinced you to reverse your decision and buy growth names once again because you believe that yields will go lower? Did you hear anything today that made a difference? Of course not, because you heard more of the same and more false assurances telling us that there is no inflation, it's well below 2%, and even if it goes over 2%, we will eyeball it and we will take decisions accordingly. But those decisions will not happen until after 2023 by tapering the bond purchasing program. But for now, we're not doing anything because inflation is not rising higher. But nowhere in this conversation were Treasury yields addressed. So Jerome once again saying, step back in the casino, stop asking questions, put your blindfold on, and continue to play the game because I got your back. Even if inflation goes out of hand and we have to taper the bond purchasing program, I will let you in advance when I'm showing an ace if I have a 10 under that card. Does it sound too good to be true? Yes, it is. Why? Because it is bullshit 100%. Jerome giving false assurances once again. He has no control over the longer end of the yield curve. Furthermore, no decision whatsoever to address the rise of Treasury yields, meaning that tomorrow the bond vigilantes could do the same and start dumping bonds, pushing yields higher, and inflation expectations will start to get higher and higher again, and yields will continue to climb and climb and climb. Zero assurances from the Federal Reserve, who is saying now, let me buy back those bonds I was dumping the last few weeks, because Jerome Powell says that he's not going to cut his own rates at the Federal Reserve until 2023. The bond market will call his bluff because inflation is rising higher, and they will continue to demand higher yields to buy these bonds. And they will continue to dump their bond holdings if they had some before, and yields will continue to go higher and higher and higher. At that point, all of a sudden, Jerome Powell, who told you not to worry about anything, tough guy Jerome got it. He's not going to raise interest rates till 2023. That's an ultimatum. I'm not thinking about anything. Let's say that we reach 2.5% in the 10-year Treasury yield before the end of this year. All of a sudden, tough guy Jerome will have to start thinking about raising interest rates. We will cover the absurdity of the press conference by Jerome Powell today and all the statements, all the garbage that he puked out of his mouth today. In addition, we will look at the implications for the market in the next few days and weeks. But for now, I got a market to cover. And here we go. The Dow Industrial Average closing in the green by 189.42 points, or a gain of 0.58%. The Nasdaq closing in the green by 53.63 points, or a gain of 0.40%. The S&P 500 closing in the green by 11.41 points, or a gain of 0.29%. And of course, the bulk of the gains came right after the decision from the Federal Reserve, and the algos were programmed to react in this fashion ahead of the decision announcement. What about the sector's performance for the day? Leading the pack at number 1 and capturing the gold medal, consumer cyclicals. At number 2 for the silver, energy. And at number 3 for the bronze, basic materials. Meanwhile, the biggest laggard of the day is utilities, closing severely in the red. So once again, a mixed message here. If Jerome's press conference was a mission accomplished, then yields should have dived lower. And if yields dived lower, then utilities should rally. This is not what we saw today. Pay attention to the blind spots in the mirror. Yields did not budge after the conference, even though the market had an orgasm. Utilities did not celebrate the decision. Utilities actually went lower. Are utilities projecting that yields will continue to surge higher regardless of the conference that took place today? That is the question. Moving on to the futures market performance. Right away, muted activities for crude oil. What about softs? We saw declines in softs futures today, led by OJ, sugar, coffee, coca, and cotton. The biggest loser, OJ futures down almost 4%. Meanwhile, lumber futures managed to close in the green. You want to talk about inflation? Lumber prices did not go down, even after the bullshit conference from Powell. And what about metals? Copper, palladium, silver, gold closing in the green. Copper did not budge at all, did not go down at all, sticking a mid-finger to Jerome's face. Inflation still going higher, yields will continue to go higher. The only laggard in metals futures was platinum, muted for the day. And what about meats? Gains across the board for live cattle, feeder cattle, and lean hogs futures. What about grains? Some modest declines here in soybeans, soybean meal, soybean oil, and oats futures. Noticeable declines for both wheat and canola futures, down by about 2% today. Meanwhile, rough rice futures managed to close with gains over 1.5%. Commodities giving a rat's ass about Jerome Powell and the propaganda efforts, and they're actually trending higher because denying inflation is not gonna make it go away. Commodity prices will continue to go higher. What do you think yields are going to do? Moving on to the big casino, the options market. And let's see how the tables did today. The STEMI money is not showing up in the options market yet. It hit bank accounts literally today, and we will start to see the STEMI money starting tomorrow and throughout next week. But for today, Apple closing at number 1 with about 1.4 million contracts, but 70% of those were calls. And at number 2, Facebook with about 470,000 contracts, but 71% of those were calls. And at number 3, Boeing with about 400,000 contracts, about 78% of those were calls. And the big question is, how will the picture change as soon as we see the STEMI money reaching the options market? The assumption is they will buy calls, and that would push equities higher. The mystery remains whether the retail trader is ready to buy the dip right now, or are they waiting for better prices? Moving on to the unusual activities that took place in the options market today, starting with the ticker CCJ. This is for a company called Cameco, and it is a uranium mining company. And somebody's making a bullish bid here by buying the 22 calls expiration date, April 16th, with expectations that the name will climb over 14%. They paid about 75 cents a piece to enter this trade, bringing the total to about $3 million. And what about this trade for the ticker BABA, for Alibaba? You know, Alibaba is in a lot of trouble here in China, but traders still like the name and they continue to buy the dip. In this case, they're buying the 250 calls expiration date April 1st, with expectations that the name will climb over 7% by then. They paid about $2 a piece to enter this trade, which brought the total all the way to $1.5 million. And what about the ticker AMTX? This is a biofuel company, one of the ESG bets. And somebody's making a bullish bet here by buying the 20 calls expiration date April 16th, with expectations that the name will climb over 5% by then. They paid about $3 a piece to enter this trade, which brought the total all the way to $1.5 million. Here's another interesting trade for the ticker 5, for 5 below, and somebody's buying the 215 calls expiring March 19th, meaning this upcoming Friday, with expectations that the name will climb over 10% by then. They paid $1.40 a piece to enter this trade, bringing the total to about $700,000. Continuing with interesting trades, what about the IWM? We have a bearish bet here by buying the 205 puts expiration date April 30th, with expectations that the IWM will decline over 12% by then, and they paid about $2.25 a piece to enter this trade. And that brought the total all the way to $1 million. And what about the ticker PDD, for Pinduoduo? They're making a bearish bid here by buying the 135 puts expiration date April 1st, with expectations that the name will decline over 10% by then. They paid about $2 a piece to enter this trade, bringing the total to about $800,000. And lastly, what about the trade for the ticker CRWD, CrowdStrike? Well, somebody's making a bullish bid here by buying the 220 calls expiration date March 26, with expectations that the name will climb over 6% by then. They paid about $3.60 a piece to enter this trade, bringing the total to about $1 million. Moving on to the headlines that shaped the day, starting with macro news. We received the housing starts in the morning, and here it is. U.S. housing starts fall sharply in February as severe winter weather hit much of the country. The Commerce Department reports starts fell 10.3% last month to a seasonally adjusted annual rate of 1,421,000 units, versus the expectations from the economists of a reading of 1,560,000 units. And single-family starts fell 8.5% to a 6-month low. What about the multi-family starts, plunging 15% to a pace of 381,000 units? Meanwhile, the multi-family permits fell 12.5% to a pace of 539,000 units. And here is the take. Costs continued to rise for builders in February. Softwood lumber prices surged to a record 79.7% year over year last month, Survey by the Associated General Contractors of America found manufacturers have hiked drywall prices by 20% effective late March, beginning of April. So once again, expect the housing bubble to get bigger and bigger and bigger because commodity prices are rising, input prices are going higher, the demand is still very hot. Meanwhile, the supply is not even there. So the housing bubble will get even crazier. And perhaps we will see the mother of all housing bubbles very soon. There will be a lot of victims because mortgage rates on the trajectory of going higher. Of course, current homeowners should exploit the opportunity, but those who are buying houses right now could have a lot of regrets later on. And here are U.S. input prices rising significantly higher in 2020 and projected to reach highs we haven't seen since 2012. This is what's behind the rise of inflation expectations that are driving yields higher. And the Federal Reserve did nothing today to address this problem. Nothing at all. There is legitimate demand in certain sectors of the economy in case of housing, for lumber, for example, but there is a shortage of supply. Now, what about the oil market? Because there is no shortage of supply right there. You can flood the market instantly with oil right away. And we know that the majority of the world is still under a lockdown, and therefore the demand for oil is not the main driver of prices. Curbing supplies and the anticipation of more hostile policies against energy here in the United States is driving prices higher. In addition to psychology, which is driving inflation expectations. Global oil demand won't return to pre-pandemic levels until 2023. And talk of super cycle may be premature, the IEA said. It is not premature because if you read history, psychology alone is capable of creating inflation, pushing the prices higher right now, and as soon as demand starts to pick up, prices will even go higher. And of course, all of this inflation and inflation expectations are impacting the bonds market by pushing yields higher. Yields on the 30-year treasuries rise to the highest since 2019. Now you might say that yes, treasuries are rising due to inflation expectations, and those are transitory. So we have to look at the real rates, bro. This is bear propaganda. Okay, let's take a look at the real rates. Here it is. The rise is being led by real yields more than inflation expectations, with 30-year real yields near the highest since the start of the pandemic. Oh, but perhaps the yields are rising for quote-unquote the good reasons, because we're about to witness the greatest phase of economic expansion ever. Well, here it is from the Atlanta Fed. On March 16, the Fed's model is now projecting the GDP, real GDP that is, will grow 5.9% in the first quarter of 2021. And that is revised down from their previous estimate. So once again, are yields really rising for quote-unquote the good reasons? Or are they rising because of the tsunami of liquidity that is causing more inflation expectations? And now we have a new round of stimulus, adding more fuel to the fire. The U.S. has issued 90 million stimulus checks worth a collective $242 billion so far as a part of President Joe Biden's landmark $1.9 trillion American Rescue Plan. So lots of stimmy are hitting bank accounts as we speak right now. But wait, there is more. Business leaders engage Biden administration about ways to pay for infrastructure because we have another bill coming for about $3 trillion or so, and they're going to call it the infrastructure bill. But the real question here is, how are we going to pay for all of that? Because we've been borrowing from the printing machine to do all of this spending. But now we have opened a massive budget deficit worth trillions of dollars. And here it is. Here is one way you will start paying for it. And it's not going to be enough at all. Biden expresses confidence he can get Democratic support for a tax hike on Americans earning above $400,000. Taxes are going higher, baby. And you might say, oh, but those are rich people making over 400 grand. This is the start. Sooner or later, they will realize that it is impossible to close the budget deficit without taxing everyone, including but especially the middle class. Senator Bernie Sanders will introduce legislation that would seek to apply an additional tax on corporations where the CEOs paid more than 50 times the median worker. But rest assured, all of this tax scare, now you got more time to plan on how you're going to stiff Uncle Sam. The Internal Revenue Service is planning to delay the April 15th tax filing deadline by about 1 month. So you got 1 more month to figure it out. Maybe you should start a SPAC. And what about the main event of the day, the FOMC meeting and the conference from Papa Jerome himself? Here it is. Federal Reserve sharply ramps up its expectations for economic growth, but indicated that there are no expected interest rates hikes through 2023, despite an improving outlook and a turn this year to higher inflation. I want you to read this over again and try to spot the problem here. He says that inflation will indeed turn higher, and the economic growth expectations got ramped higher. Okay, then that means that you have to stop the cocaine operation or at least raise interest rates at some point because inflation might go out of hand. Jerome is saying, no, I'm not going to do that until 2023, meaning that you can have your cake and eat it too. Once again, ask yourself a question. Does this sound too good to be true? And if it is, are you a sucker to believe it? You might say, Mr. Powell, that higher inflation will come and we will have better than expected economic expansion. And we are not going to hike rates all the way to 2023. But here's the question. What happens if yields start to rise higher anyways? What are you going to do then? And the answer is, don't ask these questions. Fed's Powell, seeing an uneven economic recovery. Recovery is far from complete. See notable rise in goods, spending, says services are still low. And of course, he's trying to spot the weakest areas of the economic recovery right now to hang that as an excuse for continuing the cocaine operation and not raising interest rates. So when will you start thinking about tapering the cocaine operation, Mr. Powell? And here is the answer. Ha ha ha. We're not kidding. Powell literally laughed at the question.
Is it time to start talking about tapering yet?
Because he knows he's bullshitting. He deserves the Oscar for today's performance at today's press conference, because this is what it was. It was a performance, an act from Jerome Powell to play poker live on television, and he performed an act saying that he has a royal flush. Meanwhile, he doesn't have any of these cards. And the question is, the bond market will call his bluff in time. The market might celebrate a day or two, rallying higher, saying that Papa Jerome got our back, but at the end of the day, the market will call the bluff into the story. Because Jerome doesn't have a royal flush, he doesn't have any of these cards, and we know it. What did he offer to control the rise of yields today? Absolutely nothing. But come on, Papa Jerome gave you some insurance. He said he will give you as much advance notice as possible for taper. Jerome is saying, sit down at the table, put your blindfold on, and double down. And if I have a blackjack, I'll tell you in advance. Do you believe him? Because is the dealer in control or are the cards in control? But sit down, put your blindfold on, continue to gamble, double down, go all in because Papa Jerome got your back. And he will let you know ahead of time. Oh, how generous of him, because here is the reality. Jerome Powell is saying that we will communicate ahead of time and give clear signals before tapering the cocaine operation. But what he's not telling you is that the market will make its move well ahead of Jerome even thinking about sending a signal. He is absolutely delusional, meaning that the market will make the move ahead of time before Jerome even communicates to us that he's about to taper. The bonds market will start moving ahead of time because the macro indicators will tell us that. So once again, false assurances. He offered absolutely nothing. But here is something that he offered. He pulled a trick out of Reverend Elon Musk's book of keeping expectations on edge. Make some shit up, make a big deal out of it when it's actually nothing, and keep everybody on edge. Jerome Powell maintained his silence at his press briefing Wednesday over whether the Federal Reserve will agree to Wall Street's request to extend a capital break for banks that is set to expire this month. We are talking about the SLR extension. Of course, the banks have to keep somewhat of a collateral, a buffer against their treasury and deposits holdings. And this is a part of the regulations in the aftermath of the financial crisis. Now, last year, the Federal Reserve decided to lower those requirements because he wanted banks to free up capital and start lending in the economy to speed up the recovery. But the real data suggests that this has done nothing at all to accelerate loan writing and lending in the economy, meaning that the banks did not do what was expected from them by the Federal Reserve. And the assumption is that the program should expire coming March 31st. But the Federal Reserve, Jerome Powell in this case, playing this game of, oh, let us wait, I have a decision imminent, I'm not going to talk about it, it's going to come in the next few weeks, because he is trying to manipulate something. He's trying to manipulate yields lower, manipulate equities higher. If the SLR program expires as planned, then banks will have two choices: either to increase their buffer against their treasury and deposits holdings, or the easiest choice is to dump a bunch of treasuries, and that will drive yields higher. The Fed doesn't want that, and once again keeping us on edge. For what? We know the obvious. We know the Federal Reserve will extend the program because they believe that the program will speed up and help the recovery, which is bullshit, by the way. Okay, so banks are not going to dump more treasuries. Will that solve the main problem in the markets today, specifically in the NASDAQ, which is the rise in treasury yields? Not really. It might not make it worse, but yields are still on the trajectory higher because inflation expectations continue to go higher and higher. And today we got nothing regarding addressing this problem. All what the Fed is trying to do is psychological games to distort and manipulate. And Jerome Powell might have been confused today and thought that he is at the comedy club because here it is, Fed's Powell. By some measures, some assets valuations are elevated compared to history. And of course, the journalist, quote-unquote journalist, did not follow up or ask him to elaborate. Moving on to sentiment news. While the Federal Reserve continues to deny the existence of inflation and the imminent danger of inflation rising out of control, we have legendary bond investor Bill Gross. And he said he is short treasuries and expects U.S. inflation to accelerate to 3 to 4%. And it is not just Bill Gross. The market is starting to wake up. Deutsche Bank analysts see U.S. rates as high as 3% on inflation. And here is from Wells Fargo. Don't rule out a 10-year Treasury note yield as high as 2.25 this year, says Wells Fargo. Our view is Powell will not really try to slow it down. And this is exactly what we got today. But there are propagandists and co-conspirators here in BlackRock. BlackRock Lombard says calls for faster inflation are premature. Could somebody please hand this gentleman a chart of lumber and tell us if this is premature or not? And of course, this rise in yields is changing the market's dynamics. Growth used to outperform by default, and value was thought about as value traps. This is not what's happening right now because the macro environment changed to favor value investing. And value stocks are morphing into their once feared momentum rivals. A shift that could give their rally a fresh boost. And here we have the Peter Lynch fair valuation indicator, just to show you how insane the mania has gotten in the market. We're now reading at all-time highs, surpassing the dot-com bubble. Oh, but Peter Lynch, who's that guy? What does he know about investing? We the Robin Hoodiots, are the new Peter Lynch. But perhaps the Robin Hoodiots are emboldened because of the overnight market manipulation that is becoming quite comical. All night long, most of last year's gains in the S&P 500 has come from overnight trading, meaning that if you bought the S&P 500, the SPY, during the beginning of every trading day and you sold it at the end of every trading day since the March bottom of last year, you have made pretty much nothing. Your return is at zero. So how the hell did the S&P 500 rise over 20% since the March bottom? The answer is the magic of overnight pumping from quote-unquote the mysterious entity. More in market sentiment. You know these analysts, the Wall Streeters, they get high on coke and they start issuing price targets and projections. Not a joke. The yellow bar is Wall Street's estimate for small caps earnings for 2021, almost 40% higher than its previous highs in 2018. Take a look at the chart. It is quite comical. The actual earnings for the Russell 2000 the last few quarters were actually down. Yet magically, Wall Street estimates expect a massive surge in the earnings of the Russell 2000. We are in La La Land. You have to be blind to not recognize that this is a freak show. More in sentiment news. What about Wall Street Bets? You know the geniuses over at Wall Street Bets who, according to Shamath Palate Potato Tequila, are research geniuses. So perhaps we should listen and learn something from their sentiment. Here it is. They are still bullish on GameStop, Plug Power, Tesla, Palantir, AMC, Apple, but they are bearish on the TLT and the triple Qs. So apparently these geniuses are bearish on the Qs, but somehow still bullish on Apple and Tesla. What about the 21st century's tulip mania? Ripple, whose XRP token was deemed illegal by the SEC, claims the agency is hiding internal records that would explain its views on crypto assets, accusing the SEC of being anti-crypto. And remember this guy, the king of donkeys, who could not sleep at night because he was staying up all night refreshing the page watching Bitcoin price action. And now he's saying Bank of America has a higher chance of falling than Bitcoin. What about the NFT mania? Elon Musk turns down 1 million offer to buy his tweet as an NFT. Even Reverend Elon, are you guys really that stupid? Don't pay 1 million. It's not worth it. But you know what's worth it? Here it is. The world's first NFT house is now for sale. So good news to our ever-growing homeless population. Now they can have digital housing. Can you imagine going on a date and you brag about your virtual assets? Are we going to go back to your place? Where is it? Oh, it's in my phone. It's a digital home. Please take off your digital shoes before you step in. This mania is one of the latest trends by the SPAC generation, who also happen to get their pleasures digitally on OnlyFans. And here is the ECB, the European Central Bank, trolling the tulip mania of the 21st century. Tulips are beautiful flowers for those who remember the 17th century tulip mania. They also serve as a reminder of what can happen when prices don't reflect intrinsic value. Hashtag Ask ECB. Oh really? What do you call the mania you're creating in the stock market? The bonds market. Isn't that tulip mania too? All the cocaine operation globally that are artificially inflating prices? How dare you, ECB? The audacity of talking about intrinsic values. But honestly, who cares about intrinsic values? Because the SPAC generation doesn't care about intrinsic value. They don't care about corporate profits, corporate earnings, corporate revenues. That doesn't matter. Even if you have negative revenue, they will still apply their blindfolds and stampeding Naruto style heads first, asking questions later. Matter of fact, not asking questions at all if the fraud is promoted by one of their cult leaders. Cathie Wood, Shamath Spaccaria, Reverend Elon Musk, the king of donkeys. Doesn't matter. Just feed them the ticker. And here it is. SPACs just broke the annual record for new issuance in March. And this is from Fortune magazine. It is not going to end well for investors in special purpose acquisition corporations, aka SPACs. Blank check companies, as they used to be called, were also a fixture of my youth. That is, my youth as a reporter covering the IPO market some decades ago. But back then, they were frequently fraudulent and excluded from IPO rankings. Congress cracked down on the practice of raising money and going public with no business plan other than the goal of making an acquisition, and that was that for a very long time. So just understand that SPACs were banned for being a fraud to begin with, but here it is. But in kind of the same way that some enterprising lawyers read Section 401k of the tax code and invented something new for retirement savings. Some smart legal minds pored over the Securities and Exchange Commission Rule 419, which defined an illegal blank check company to find a way to make a legal special purpose acquisition corporation or SPAC. Unfortunately, as we've been cataloging here, the SPAC boom now looks like an out-of-control bubble of speculation, particularly if you focus on EV companies like Nikola and Lordstown that have been hit by allegations of misleading investors. 3 exchange-traded funds just own SPACs. Now another is debuting that will only short SPACs. So we have the D-SPAC ETF. These kind of things never end well. I fear that the SPAC apocalypse is near. Like the song goes, you can get what you want or you can just get old. You're gonna kick it off before you even get halfway through. And Vienna waits for you. But hey, what do you know, boomer? You know these Wall Street bets and the SPAC generation? When you try to argue with them, even the culties with Tesla and the likes, when you try to debate these zombies about valuations, about the danger, speculations, etc., they will call you and dismiss you with, okay, boomer. And they say that to me too, even though I'm not a boomer. But perhaps these donkeys should embrace their older counterparts and learn from them rather than mocking them. Because some of these quote-unquote boomers have been donkeys before, and donkeys should be learning from former donkeys not to make the same mistakes. But of course, the Robin Hoodiots are an arrogant bunch, and they believe that they know it all. And by the way, for new subscribers, when I say the Robin Hoodiots, I'm not insulting Robinhood users. The Robin Hoodiots is a description of a new generation of investors who believe that stocks only go up and there are no red days. And even if there are red days, they are an opportunity to buy. And you put your blindfold on and you stampede Naruto style, looking for tickers and buy. Ask questions later. Matter of fact, don't ask questions at all. And speaking of the Robin Hoodiots, we are moving to corporate news, starting with Robinhood. Robinhood is making its offer just as millions of Americans begin receiving the $1,400 stimmy. And they are talking about Robinhood incentives. If you open an account right now, they will give you $25 for free, $50, even $100. And this promotion magically was scheduled on the same date Americans were receiving their $1,400 stimmies. But hey, Robinhood is not trying to exploit the traders and retail investors. Robinhood is just trying to make it easier for them to lose their money. And speaking of losing money, here it is. You know, the Robinhoodiots, they chase all of these tickers under the excuse of, oh, it's the future, bro. Even though the companies, some of them don't even have profits or even revenues. But that doesn't matter. Just use some buzzwords such as EV, hydrogen, ESG, solar, cyber, digital, virtual, and you get their money because the wallets are wide open. And some of these names like Plug Power, Blink Charging, Fuel Cell, etc. But we're talking about Plug Power because here it is. The hydrogen fuel cell company is restating financial statements from the past few years because they got caught in their statements showing that they have a negative revenue of over $100 million and negative revenue. Once again, either the accountants were high on meth or the company is doing fraud. And Plug Power is down over 50% from the highs. Remember when the Robinhoodiots in the comments used to say, oh, where is the dumping? The dumping is never gonna happen. This guy's a perma bear and Fuel Cell and Plug Power is the future, bro. Well, here comes the dumping. Down over 50% from the highs. But wait, there is more. What about VW? We've been talking about VW and I've been predicting that this stock will be the next momentum play all the way back since last year. And the reason is the EV mania got very bloated in names like Tesla, NIO, Xpeng, Li Auto, and they started chasing traditional names like General Motors, Ford, Toyota, but somehow they forgot to chase one of the most important names in the EV future, VW. And all of a sudden, it only took a little bit of time before it caught up to the hype, and you see shares of VW surging significantly higher the last few days, and now it became the most valuable company in the German stock exchange, surpassing SAP. And where is the next opportunity in the EV mania, by the way? Is there any lagging name in the auto manufacturers? Well, GM is hot, Ford is up big, Li, NIO, Xpeng, Tesla, all of these surging higher already. Toyota is also trading higher, but there is one name that is still lagging, and that name is Honda. Wait till Honda becomes the new EV play. The problem is that Honda executives are a bunch of morons. The mania is right here, the zombies are already stampeding all over the place, their wallets are wide open, and somehow magically Honda forgot to milk the EV mania. Announce something, anything. It doesn't matter if it is real or not. It could be even an NFT EV, a digital EV from Honda. Doesn't matter. The zombies will stampede and push Honda's stock higher. Where the hell are Honda executives? But hold your horses right there, because I got some bad news for you. Exclusive. Honda temporarily cutting production at all US and Canada plants. What's going on here? The Japanese automaker added the issue we are talking about, the chip shortage here, will result in some production cuts next week at all US and Canadian plants, citing the impact from COVID-19, congestion at various ports, the microchip shortage, and severe winter weather over the past several weeks. In some way, all of our auto plants in the US and Canada will be impacted, Honda said. The chip shortage, which has hit most of the global automakers, stems from a confluence of factors as car makers, which shut plants for 2 months during the COVID-19 pandemic last year, compete with the sprawling consumer electronics industry for chip supplies, meaning that the issue will impact all other auto manufacturers, not just Honda. And perhaps the mania already came and went by without Honda milking the mania. What a bunch of morons these executives are. Oh, what about Disney? Here it is. Disneyland to reopen on April 30, Disney CEO said. But perhaps they don't need a park anymore, a physical park at least. Perhaps Disney should start a virtual park, a digital park, and make money by selling a bunch of NFTs in the virtual park. You see what I'm saying? Where are you? I'm at Disneyland. But wait a minute, you're here, and you have your blindfold on. Where are you? I'm at the virtual Disneyland, bro, and I'm buying a digital cotton candy. Would you like to buy it from me as an NFT? I don't have a picture, but it does exist in my head. Moving on to Uber. Uber will reclassify all of its 70,000 UK drivers as workers, entitling them to the minimum wage, vacation pay, and other benefits after a landmark ruling last month. But the geniuses of Wall Street still recommend the stock as a buy. And what about the evil empire of Amazon? Here it is. Amazon unseats Walmart to become the #1 apparel retailer in the US, UBS says. Here is more from the evil empire. Amazon is launching its telehealth business for other companies and the rest of its employees. We saw shares of Teladoc crashing severely today. Teladoc happens to be one of the holdings of Tesla witch Cathie Wood ARK ETF. And how can we do corporate news, nightly corporate news, without covering the souffle? Tesla operating an autopilot hits police car in Michigan, officials say. And of course, luckily for the Tesla driver, the color of his vehicle wasn't black. Otherwise, the cops would have choked the car to death. Moving on to the heat map analysis, and let's see what's going on here. What is the theme? The theme is we are still confused and we have no clue what these dumb algos did today. Because here it is, you're seeing the cyclical trade of industrials, financials, energy, materials outperforming today. Likewise, technology and the mania names managed to close well above the lows, and some names managed to score big gains, Tesla closing over 3.5%, but we saw big technology, Apple, Microsoft, Google muted, meanwhile modest gains for both Facebook and Amazon. So the take here is that in the aftermath of the Fed's meeting and Jerome Powell's conference, the algos decided to pump everything higher, and we will start combing through the move starting tomorrow and next week. Meaning, should we continue to rally the inflationary trade, or should we buy the dip in the deflationary names of tech and high growth momentum? To answer this question, why don't we visit the themes analysis and see what we can extract there? Starting with the nostalgia stocks, aka the reopening stocks. Mostly in the green, we saw buying of these reopening names, so there is no problem here. The reopening trade is still hot, catching a bid once again. What about the high inflation stocks, the inflationary names? Mixed picture, some gains in the most important sectors such as financials, certain industrial names like Boeing, Deere, Hubble closing in the green, big gains for Alcoa, but we also saw retreats from UPS, Waste Management, CarMax, Kroger, so it's a mixed picture, no conclusion whatsoever. What about the deflationary trade? The tech and high momentum especially. Mixed picture, some gains here and there, but all in all, muted activities. So how do we make the decision of which sector of the market was lying today in the move higher? Which trade will be faded once market participants comb through the movement today? Let's go to the origins. What has been the tailwind for the inflationary trade to rise higher? The rise in treasury yields and inflation expectations. What has been the headwinds for the deflationary trade, specifically in the high valuation names? Also the rise in yields and inflation expectations. Did the Federal Reserve do anything today, anything tangible to lower inflation expectations or to prevent yields from rising impulsively higher again? The answer is no. So I believe you are smart enough to figure out which trade will be faded. Moving on to the charts analysis, starting with the SPY 15 minutes chart. Anything to see here? Nothing at all. The series of higher lows goes on, and we have a bull flag formation that is supposed to take us higher. Is it a trap? Is it not a trap? I have no clue. I am just interpreting the charts for you as I see them. Bull flag will take us higher. Zooming out to the daily chart of the S&P 500, the continuous contract, still struggling, gathering energy to have that impulsive break above the important resistance line of 3,960. We managed to close at 3,961, which is above the resistance line by $1. The question is, where is the impulsive break higher? Could it happen starting tomorrow? It should happen by the end of the week. If it doesn't happen, then you have an ominous signal for the SPY. It has to happen before the end of the week. We have 2 days to break impulsively higher over 3,960. Moving on to the Qs. What's going on here? The Qs should not go all the way down to 313. That is the danger zone. If you fall back to 313, you're gonna fail and you're gonna go lower. If we fail 313, then we have a massive reversal ahead of us. So for now, the Jerome pump took us all the way back to 323, even though we gapped lower in the morning. So we're back where we started yesterday. 323 remains resistance, 313 support, but it is a trap. If you go to 313, you will be stabbed in the back and thrown lower. Now, what about the continuous contract, the daily picture of the NASDAQ? Once again, my target is the purple trend line. We tried yesterday, it didn't happen. We tried again today with no success, but it doesn't mean a failure. It just means that it didn't happen the first time, it didn't happen a second time. Could it happen the third time? Is third time a charm? Well, it has to happen before the end of the week. Not closing above the purple line by the end of the week will mean trouble for the NASDAQ. What about the IWM 15 minutes chart? Once again, gapping lower, struggling at the lower limit of the trading channel, back and forth, and then comes the Jerome pump, and the IWM managed to close above the lower end of the trading channel, and now it is back within the channel. Zooming out for more clarity, here it is, we're back at the channel. However, we did not manage to close above the reversal candle from yesterday, and that remains the target. You got 2 days to close above the reversal candle from yesterday. If that doesn't happen, the lower prices are in the future of the IWM. What about the Dixie, the dollar index? It was consolidating just below 92, and the expectations was that the dollar will blast higher. We saw the opposite taking place. The dollar flushed lower right away after the FOMC decision. But remember, I call it tricky Dixie because it will make a move, giving you a certain impression, only to reverse the move the very next day, and therefore tricky Dixie. What about gold? Gold surging higher, finally breaking out from the bull flag formation that I identified for you, and we should reach 1765. Of course, gold is rallying on the heels of the turn lower in the US dollar. So if Tricky Dixie will reverse the move tomorrow, then gold will trade lower, assuming that gold moved higher only based on the movement of the US dollar. And of course, Peter Schiff gets to breathe today. What about Bitcoin? What's going on here? Nothing is going on. A series of higher highs and higher lows, and we should be trading higher. The reversal will happen if you start trading lower without making a higher high. That would be the start of an ominous signal for Bitcoin. We are not there yet. We don't have any reversal signal whatsoever in Bitcoin. Moving on to Treasury yields, the TNX. We talked about a bull flag formation. We broke out higher. And of course, the market had a massive orgasm listening to Jerome Powell. But the bonds market is telling a different story. The bonds market is saying nothing changed. Nothing happened whatsoever. Yields closing significantly higher today. And therefore, be careful trusting the knee-jerk reaction in the stock market today. It has to be confirmed with the bond market first. Moving on to the chart of the 10-year bond. And I'm showing you this. This is a monthly chart, or weekly chart rather, to illustrate for you what the bulls are bidding on. The bulls are bidding on a reversal in the prices of bonds, pushing yields lower. And that in turn will ease the concerns about overvaluations in the technology sector, specifically the NASDAQ. So if you're a bull and you're reading the tea leaves, you're hoping the bonds will catch support from here, yields will reverse lower, and you will see the NASDAQ going higher. So the temporary band-aid from whatever propaganda Jerome Powell did in today's press conference, you're hoping that that will stick for a little while. If you're a bear on the market, you want to see a break below this support line. That would be an extremely ominous signal because it will show a change in regime, a confirmation of that regime change in the bond market. What about the VIX? The VIX closing below 20 once again, and it is emboldening the bulls. Now, if you are bullish on the market, you have a lot of support here. Number one, you're betting on a rebound in the bonds market for support to hold. You're also betting that the VIX will close below 20. That would embolden the algos to push the S&P 500 higher. You also have the support from the algos pushing stock prices higher in reaction of the Fed's decision. Is this sustainable by the algos or not? That remains to be seen. But for now, the bulls have a lot of support behind their argument that we will see a blow-off top rally, at least in the S&P 500. The bears, at least in my case, we're not bearish on the S&P 500 or the inflationary trade. We are bearish on the NASDAQ and the high momentum, high valuation trade. And the argument for the bears in this case is nothing changed from the Federal Reserve whatsoever. The factors pushing yields higher are still here, nothing was remedied, and there is nothing stopping us from pushing yields even higher. Moving on to Apple, 15 minutes chart. Apple dipping below 125, that was the important level to defend, and after the Jerome pump, Apple managed to recapture 125, but closed slightly below that. The closing was 124.82, and the goal was 125. We're not going to make a big deal out of it, but it is notable. Once again, remember, as Apple goes, so will the NASDAQ. What about Tesla? In yesterday's video, we talked about two important levels. On the upside, Tesla must close above 700 because the rejection from 700 yesterday was a bad signal, predicting lower prices for Tesla. And this is exactly what we got in the morning. Tesla gapping lower, and we had a target on the downside, 679. Tesla must not close below 679, and it should start closing above 700. That was the challenge for Tesla. And guess what? In the morning, we gapped lower and below 679, but after the Jerome pump, Tesla managed to close in the green decisively and recapturing 700. So there is nothing bearish about this close. If anything, it was a good fight from Tesla and closing very bullish. The challenge is, this is the next challenge by the way, is for Tesla to break out from the bull flag consolidation without closing below 700. Closing below 700 by the end of the week and not breaking higher, that would be an ominous signal. So you have Tesla, you're looking for a closing in the weekly chart way above 700, breaking out the consolidation of the bull flag. You're looking for Apple, 125, weekly close. It has to be above 125. You're looking for the NASDAQ. The continuous contract must recapture the purple trend line by the end of the week. The S&P 500, the continuous contract. What is the mission here? Closing above 3,960, the weekly close. There you have your targets. The market turns bullish if we manage to close above these numbers. And if you have a reversal in yields, then that is your indication that the market will have a bull run, at least in the short term, before reversing lower, because the issue that drove yields higher is still there. Inflation expectations are still shooting higher. And here is the last chart of the day for Viacom. We talked about this name during the weekend video, and I mentioned that if I see Viacom trading above 100, I will be shorting with both hands. And I did issue a tweet announcing that I opened a short position via buying puts on Viacom right away. And of course, the name went down over 10% today. I did close some of the puts, but I also sold Viacom puts expiring this Friday, meaning that I turned some of my puts into a calendar trade. And where do we see the stock going from here? Here is the 15 minutes chart. We have a clear reversal of the trend, and we are consolidating in a bear flag formation that is supposed to take us lower. When does this formation go out of the window, closing the gap? There's a gap from a 15 minutes perspective because we started the day gapping lower in Viacom. If that is closed, then there are higher highs for Viacom. And you'll know that right away. You don't have to wait till the gap to be closed. You will know if Viacom starts blasting higher tomorrow that there is more appetite for buying the stock. But for now, we saw a clear reversal here, a loss of momentum, and a bear flag consolidation that should take us to lower prices. And now, moving on to conclude this video. Same old, same old. The algos pushing the market higher, giving us the all clear signal. But did Jerome Powell and the Federal Reserve offer anything different in today's decision and press conference? Absolutely not. There's nothing preventing yields from rising higher again. There is nothing preventing inflation expectations from rising higher. So what was all the fuss about? It was just algos doing what algos do. The bond market has to confirm the move higher. If we see Treasury yields shooting higher overnight again, then forget about it. The NASDAQ and the high growth, high momentum names will reverse and weaken once again. Meanwhile, the cyclical trade could continue to rise higher. We're talking about the inflationary trade. But we are done with the FOMC meeting and the Federal Reserve decision. The next thing for the market to look forward to is number one, the quad witching, which is Friday's options expiration, March 19th. A lot of funny business will take place there. And the reason is lots of puts been sold, lots of calls been sold by market makers, and they will have to park the market where maximum pain is. What is maximum pain? To make the majority of calls and puts expire worthless. And then we have the stimmy checks. And the stimmy checks started hitting bank accounts as soon as today, meaning that some of that money will start to appear in Robinhood accounts tomorrow. But the real impact will take place during next week. The assumption is the retail traders will use the money to buy the dip, which on paper should drive stocks higher, specifically the momentum and the retail crowd favorite names. The problem is if yields don't retreat, it won't matter what the stimmy maniacs are gonna do, because you know what's transitory is the pump that the NASDAQ and high momentum names will receive from stimmy checks if yields continue to rise higher. So the most important thing to watch here during the last remaining days for this week is the bonds market. Who the hell cares what happened in the stock market today? The bond market is the one to watch. If yields don't retreat tomorrow, then you have a loud and clear message by the bond market saying, "F you, Papa Jerome."
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.